and welcome. Midcaps are exciting wealth creators, but also risky if you get them wrong. So, how do fund managers separate opportunity from traps? Let's find out from our guest today, Kirti Dalvi, fund manager at Mahindra Manulife Mutual Fund, where she manages the Midcap Fund along with Krishna Sangvi and Manish Lodha. In this conversation, we'll talk about valuations, her investment style, and how she navigates mistakes when calls don't go as planned, and much more. Welcome, Kirti.
Thank you very much.
Let's start with the big picture. Valuations across the markets, they're looking stretched after the strong rally of the past few years. So, how do you see the market from here? Does the high starting point make you cautious, or do you still find reasons to stay constructive?
Okay. Well, first of all, I do agree. The valuation points are pretty high currently. But if you say that, does it make me cautious today? Of course, the answer is yes. The rally has happened, but the only thing I would like to say that we need to be cautious always at any point in time when taking the investment decisions. The construct doesn't change just because we have outperformance significantly for last whatever 1.5 year, especially in the mid cap space. What I am constructive currently today, if you see the factors, okay, currently the country with say a double-digit nominal GDP growth, well-functioning democracy, stability of the policy reforms, better infrastructure, and the most important point, the rising entrepreneurial class, along with the other supporting elements like lower oil prices, leading to lower inflation, structurally lower interest rates as well. These are acting as a catalyst for the growth. If one sees these factors, a confluence of all these factors, domestic as well as the macro, the implications are that India will become the most sought after market for the world. It will obviously undergo major energy transition. The credit to GDP ratio will go up because of this. So the manufacturing share also will gain the significant overall share in the GDP pie. So high growth with low volatility, falling interest rate scenario, it generally leads to a higher valuation, the higher P, and that is what is happening. So given the growth potential our country offers, I remain very constructive on our economy per se.
Now, Kriti, looking back at your few years, you have worked with Enam Securities for a long period of time. What were the most durable learnings from that time, and how have they shaped up your stock picking framework in the current scenario?
I was with Enam Asset Management for almost 17.5 years. It was a great journey. It was a great learning indeed, and it has shaped up a large part of my thinking and whatever I am today in terms of my investment philosophy. And I'm carrying that legacy today here. Fortunately, Mahindra Manulife and offers me the same. We follow the same investment philosophy, so there is not much change in my investment strategy or philosophy per se. The great learnings, what has happened in Enam AMC, if I have to say, which is again helped me to sharpen my thinking today, is understanding the modes of the businesses. Okay, history is the biggest teacher. Hence, the past track record analysis, the factors which can change going forward for companies or particularly any sectors or any emerging things which can play out. A lot of groundwork in terms of detailed analysis. And continuously be on track. I mean, we are living in a very dynamic environment, dynamic as well as the volatile. So you have to be on the ground. You have to be having the pulse of these trends, sectors, companies, so that the learning should not change or learning should not stop at any point in time. Even if you have invested today, the constant monitoring of that. But the basic philosophy remains in constant, and look for those long-term growth opportunities, the sustainable returns. These are the things which I have learned there, and I'm implementing rather here as well. And in Mahindra Manulife also, we follow GCMV framework, which is aligned to this philosophy, which is growth, cash flow, management, and valuations. So these are the great learnings, whatever I have had at Enam.
Talking about your investment philosophy and style of investing, is it more bottom-up stock picking, or do you also bring in top-down themes when building the portfolios? Also, if you could just elaborate on your investment style and strategy.
Sure. I focus on the bottom-up stock picking, and at aggregation of that leads to sector underweight or overweight. Top-down themes are generally used to scan the overall sustainable, the business opportunities for those companies. So those macro factors are very, very essentials, but just because the sector looks good, just we have to be part of it. I do not generally use that as my criteria for investments. I would focus more on the company. So when you talk about my investment style, I would like to participate in companies with leadership in their respective sectors, having differentiated advantages like niche technology, cost leadership, product scalability, diversified distribution, etc. It can be a turnaround candidate having significant potential to generate higher cash flows. So because there could have been certain period where the business models undergo certain changes structurally, and there is a change in the management, all those factors also I evaluate at any point in time to build a portfolio. So this is generally the investment philosophy I follow.
Now, Kirti, when everything looks expensive, what's your process of finding businesses still worth adding in the portfolio?
So when the environment is very expensive, generally the factors which can differentiate and can be an addition to the portfolio within the segment, if first of all you have to be positive on the overall business theme of that particular company, but relative competitive advantage the company can or will enjoy relative to the peers. How much growth is currently priced in, which I spoke about, compared to the current valuation. And most important factor in any higher valuation environment is the downside risk. When you're building your hypothesis, first of all, when you start, what is the basic criteria why you're investing into that? Okay. And based on this, at any point in journey, when you're evaluating even the existing position for that matter, for you to stay put in that, how's the investment hypothesis is panning out? Is there a change in that? And again, when you say a mid-cap company specifically, they are always in a very high growth phase. So balance between your risk and potential returns becomes very important to mitigate that downside risk. So these are the factors to evaluate.
Right. And when it comes to high PE businesses, what conditions? Is it growth, visibility, cash flows, balance sheet strength? What is it that makes you comfortable taking that call?
First of all, if there is a high PE which is paid, is purely because they are showing you the high growth and visibility. So those are non-negotiable factors in a high valuation companies. Also the tangibility and visibility of that growth as well. I mean, over a period of what time? I mean, when you're having 2 years, 5 years, 10 years, because in the long term, everything looks good for any company for that matter. But the duration of that visibility and tangibility, as well as the relative valuations. There are companies which are in a cyclical phase as well. You should monitor what are the valuations during those cyclical periods they have gone through. So the relative valuation vis-a-vis peers, relative valuation vis-a-vis their historical track record during those growth phases, how those companies have panned out, and most important, whether the levers of those growth have changed. If you see our history, whenever there is a novel concept, the advantage if you're a first entrant you get is always higher. So the valuation always will be higher for the new entrants, or the first entrant benefits what you get. Those benefits will not always pan out when the technology get replicated. There is enough competitive pressures which comes into the picture. So just because somebody else enjoyed those high valuation, not necessarily those valuations can get percolated to the tier 2 and tier 3 companies. So unless and until they have some niche advantage to offer, those valuations will not. So you have to evaluate the company from those fundamental point of view, and then the valuations, and that will be the criteria that you will play on those high PE companies.
Now, Kriti, once you're invested, how do you judge if the valuations have run too far ahead of the fundamentals, and at what point of time do you start trimming in the portfolio?
So, as I said, it starts first of all why I have invested. At every point in time, when you are taking that decision of reducing the exposure or trimming or selling, first thing is the reason for you to make an investment. That's the first point. And if your hypothesis is, say, of taking minimum 12 to 24 or 18 to 24 kind of view, then the only factor which can lead for you to reduce that exposure would be either the structural change, which is negative for the sector or the company, leading to lower earnings, because what you must have factored in terms of your earning performance is not panning out. There is some governance parameters have changed. Also, if you have taken a horizon for, say, 18 to 24 months, and those returns pans out too quick, where the valuation gets stretched from that point of view. Nothing wrong with the structural or anything fundamentally changed with the company, but the returns you have achieved too fast compared to what you were anticipating it, leading to those kind of higher valuation, could be a reason probably to trim the exposures. Otherwise, it makes sense if you have done so much groundwork and bottom up stock picking. If you're so confident on the company, unless one of these reasons pan out, there is no reason to trim the position or reduce the exposure.
Moving on to a few fund-specific questions. Your mid-cap fund, it has had a strong long-term track record, but the past year has been relatively softer. So, which specific calls did not play out as expected, and what are the lessons that you've drawn from what happened?
So I joined Mahindra Manulife in November 2024. In the last 8 to 9 months, if I see the fund performance, first of all, I have to give the credit to my predecessors. They have done a phenomenal job in delivering very good returns. We have seen if you see March 23 to November 24 kind of period, where mid-cap and small-cap segment per se had tremendous inflows in terms of the overall market. And I'm talking the overall India markets per se. And within that, this particular category had a lot of investor participation. Valuations is also a function of demand supply today. The more demand for this particular category has driven up the valuations as well for many companies. Is also we have seen in last 1.5 years the kind of growth they have replicated, and that's where the valuations have been paid to those companies. When those earnings don't pan out, we have seen the correction as well, apart from the investor participation getting reduced. If I see the fund performance from that point of view, some of the bets, probably the overweight on being consumer durables, or say certain segments which were the beneficiaries of certain factors like summer season, and which has been little weak. So some of those calls probably have not played out. Nothing wrong with those companies, remains pretty much fundamentally strong on those sectors or those companies, but it is just the cyclical part of that has impacted to a certain extent. In terms of correction wise or taking action on how to improve that performance today, some of the positions we have curtailed. There were, as a strategy, I would like to have a bit more higher weightages or a bit concentrated kind of position. So there were certain positions which were not moving the needle despite being positive. So wherever I am positive, I have increased the weightages so that it adds to the portfolio performance positively. And some of the positions which were very small, wouldn't have made any difference to the portfolio, have been exited for the other reasons apart from not being positive on those certain stocks. So some of the corrections we have taken, I have to say that the kind of actions globally which are happening, for you to reflect on that portfolio takes a little bit more time. That's been the volatility we are living through, but we have to live through it. There is no choice. We have to maneuver our way and deliver the returns. So our constant endeavor is to monitor the portfolio, adapt and adjust, not to be rigid, flexible enough, humble enough to accept the reality and act on it.
We have noticed that besides the core long-term picks, the fund also has some short-term or tactical bets, as we say. So, two things: what percentage of the portfolio is dedicated to this tactical positions, and also how do you determine these allocations?
So generally our view is to take a view on the, as I said, 18 to 24 months. The tactical bets have been very minuscule. I won't call it as a short-term or a tactical bets. That call would have been taken on many of these positions. Probably if you think it is a tactical, would be the relative valuations. At certain point in time, the kind of opportunity those companies offer at a valuations, at a prices, makes it compelling buy. And that is the reason those companies or the stocks are there in the portfolio today. But there is nothing like short-term phenomena in terms of making quick opportunistic returns. Generally, I don't follow that investment philosophy for the fund.
So in periods of underperformance, are you saying that, do you prefer holding conviction bets or making active changes changes to regain momentum or anything?
No, so see, the philosophy for me is to be a long-term investor and look for those sustainable investable returns. So nothing to, just because something is moving you should participate in those stocks. No, I do not follow that strategy. If I am conviction, I have my conviction. As I said, some of the stock calls we have taken have not panned out. Does that change your investment philosophy on those stocks because of certain cyclical factors not playing out? The answer is no. Probably you can adjust. The risk management happens at the weightage level. If those things don't pan out, not at the stock level, that risk addressment can happen at the overall macro portfolio construct weightage wise, but not at the stock wise. So if I have a conviction on a particular stock, I won't change it unless and until my investment hypothesis had changed. To gain momentum, just to add the portfolio stock and probably take that quick returns, have that perspective. First of all, one needs to know whether you'll be able to make that quick returns in such a short span of time. I generally don't think on any of the stock from that point of view.
Right.
Now, Kriti, moving to some of the sectoral bets, industrials and financials are your biggest exposure as of now. So, what makes you positive on these sectors? And within them, what type of businesses do you typically prefer, and which are the stocks you avoid?
See, if you see FY25 as a year, okay, it was marked by slowdown in growth rates, tight liquidity, over leverage, customers, leading to defaults in unsecured loans and tough regulatory regime, right? Going ahead, we are seeing couple of key trends is benign rate environment with comfortable liquidity backed by relatively cleaner balance sheet. There is a faster resolution of your regulatory and compliance issues as well. The system credit growth, which is hovering currently, we are seeing in double digits for the current fiscal year, will have this liquidity-led tailwinds, to aid growth in the second half of FY26. Retail, SME, MSME sectors will be the key growth drivers for that matter. So credit cost, according to us, is continue to be at a lower level. Unsecured pain seems to be picking. The recent regulatory decisions will be very supportive of growth for both the banks and the NBFCs. If you see top private banks, their profitability was always relatively stronger. But if you see even PSU bank balance sheets today, it remains in the best shape in a decade with their ROEs and ROEs in a better zone in terms of say 1% and 15% plus kind of range respectively. So given this strong economic background, the valuations of this sector are undemanding, and that's why we remain positive on the same. And within this space, again, it boils down to the relative opportunities the individual, the banks or the individual companies offer.
You also remain overweight on IT despite the headlines around global slowdown and layoffs and margin pressures. How are you viewing this sector in that backdrop, and what makes you comfortable staying invested here?
Sure. If you see I handle the mid-cap fund. So my focus is more on the mid-cap segment within the IT as well. If you see the overall environment, okay, the global, the larger deals, what used to happen, have now broken into the smaller deals. And that's where these mid-cap companies, the tier 2 companies, are gaining significant market share. Their growth is higher. As I said, the mid-cap companies get those higher valuations for the higher growth. So if you compare the growth of the mid-cap companies or the tier 2 companies vis-a-vis the tier 1, the growth rates are far, far higher than the tier 1. That's where the earning growth visibility is higher. Second thing, most of these mid-cap companies, if you see, they are getting into this one, they're now crossing $1 billion plus, the revenue size. So they are more contenders for these larger deals because generally their global clients look for these kind of parameters as well. And ownership structure in many of these companies is also making a difference. The leadership change is making the management materially aligned to the growth parameters. So that is also one of the factors. Now one sees the kind of AI change, what is happening. So some of these companies actually are beneficiaries of AI, the kind of offerings they do. So if it is not only the more maintenance kind of work, but the more technology-driven AI platforms, what these companies can offer, can lead that visibility for the next reform which is happening on the AI space in the overall macro front. Also, one of the factors one needs to be cognizant about is the relative valuation, which I spoke about. Some of these companies are available at a relatively cheaper valuation with those kind of higher ROEs, higher ROCs, better dividend yield ratios, and offering the cheaper valuation relative to their own history gives me in the higher valuation or higher P environment relative safer bets to have it. Also, given our view, or rather the kind of macro which is panning out, that global, the interest rate in the US market, which is relatively, is the largest share for majority of the IT companies in India. Possible rate cuts can be a beneficiary for the Indian IT companies, because that's where the pains will be more. It's also one of the call we have taken here.
Now, how closely do you track the benchmark while building the portfolio?
See, benchmark, obviously, if I have to say it, we are aware about it, but not guided by it. Uh, it's at the sector level, at the stock level. If I have to see if I am positive on any particular stock, and it has a sizable weightage in that index, I would like to go aggressive, because that's where the alpha generation happens. Being a bottom up stock picker. But apart from that, the sector weightages do matter in terms of balancing the overall portfolio, but it is not the guiding factor for you to take the position. So if any of the sector which having a weight in overall benchmark I may or may not be a presence in that particular segment at all, if I do not have a positive view on the particular company. So it is not the factor to guide the portfolio construction for me.
What are your hard rules on position sizing and liquidity, especially in less liquid mid-cap names?
See, internally we have rules for investment department here, that for mid cap and small cap we have a 3.5% and 2.5% cap weightage. The cap for the weight for individual fund applies to everywhere, applies to all the schemes in our company. So if I want to take any position higher than that, we have to the CIO concurrence is required for that. But that's the risk mitigation we have it here, that any mid cap stock will not exceed at the start of investing at 3.5% and small cap at 2.5%. Apart from that, managing the liquidity, you have to see it in terms of the daily volumes, the delivery volumes, and the averaging, and also how much weightage I want to have it in that particular portfolio. So it's a function of all these factors playing into account. As a manager, I like to have a little more concentrated or higher weightage positions, because that's where the performance can come when you are a positive and a bottom-up stock picker. Minor presence in our mere positions will not add any value to the portfolio if you are a positive and want to generate alpha.
And finally, what usually triggers a sell decision? It's a broken thesis, governance concerns, or the stretch valuation?
See, I have to say all the factors, but the most importantly, because each and every factor plays a crucial role in making your decision. And I would say buying decision is little easier because it's a start point. Exiting, because there is always a guilt that you exited at early, or there is a guilt that you couldn't exit at the right point in time. But as I said, it starts with the basic investment philosophies. There are key reasons why you have invested in a particular stock. When you're making the decision of a sale, first I would like to talk on that individual stock. What has changed? Any structural changes, whether it is on the macro level or the sector, or at the company level, if there are any changes. If there is not, then how much is the growth is already priced in. Then the relative valuation. Suppose you have invested in any particular stock with all the investment hypothesis you had, but if there is a relative opportunity which emerges in the similar sector with your investment philosophy, and the existing stock has already run up in terms of the stretch valuation, then there could be a chance that probably you may trim or reduce the exposure and participate in relative better valuation investment opportunity. That is one of the reasons. Sell decision, completely exiting any particular stock, is only the function could be change in your hypothesis, structural changes, governance issues, and absolutely stretch valuations. Beyond that, if you don't see this stock 3 to 4 years, over a longer period, if it is say a few months horizon, which is still okay. But if you are saying 18 to 24 months, you're not seeing any returns and you have captured the valuation gap, historical gap, as well as the futuristic one, then probably can be a sell decision for us.
All right. Well, with that, time to wrap up this conversation. Thank you, Kirti, for sharing your insights.
Likewise. Thank you very much for having me. Thank you.
And thank you for watching. We'll be back soon with more conversations to help you become a smarter investor.